Imagine you wake up tomorrow and discover that the profits sustaining the greatest tech boom in history were never completely real. We are not talking about outright fraud. We are talking about something far more sophisticated, something happening inside the balance sheets of the world's largest companies, right in front of everyone, with the blessing of auditors and Wall Street analysts. And almost nobody is asking the right questions. Over the last 2 years, the stocks of the biggest tech companies have risen in ways that would make any investor from the 90s feel nostalgic. Nvidia, Microsoft, Meta, Alphabet, Amazon, all carrying stratospheric valuations, all justified by the same narrative. Artificial intelligence is going to change everything, and whoever dominates this race will be printing money for the next 20 years. But what if that premise is wrong? Not in a naive way, but wrong in a very specific, very technical, and very dangerous way for anyone who has money invested in these companies right now. If you're not subscribed to this channel yet, do it now. The kind of analysis you're about to see does not show up in mainstream financial media. There is a line in the balance sheets of these companies that most people completely ignore. It is called stock-based compensation, and it is perhaps the greatest accounting trick operating in plain sight in modern financial markets. The logic is simple. Instead of paying employees in cash, the company issues shares. That sounds neutral, but it is not, because every time new shares are issued, the value of each existing share goes down. If you have a slice of a pizza and someone cuts more slices, your piece gets smaller. When a company reports $15 billion in profit but issued $4 billion in new shares to pay employees, the real profit for a shareholder is $11 billion. But it is the 15 billion number that goes in the headline of the press release. It is the 15 billion number that moves the stock in after-hours trading. And companies have found an elegant way to hide this problem. It is called a share buyback. The company uses cash to repurchase its own shares, reducing the number in circulation and making earnings per share appear to grow. But the cash is gone. And at a moment when these same companies are promising to invest hundreds of billions in artificial intelligence infrastructure, the question of how much real cash is actually available is not a detail. It is the central question. Now comes the layer that is going to keep a lot of people up at night. Microsoft announced plans to invest $80 billion in data centers in 2025 alone. Amazon, tens of billions per year. Alphabet, Meta, all revising their capital expenditure plans upward every single quarter. These numbers are presented as proof of confidence in the future. But there is a question almost nobody asks. Does this investment show up as an expense on the income statement? The answer, largely, is no. Capital expenditure on physical assets does not reduce reported profit. It is depreciated over years, which means you could be looking at a company with apparently magnificent operating margins, while in practice, it is burning tens of billions on infrastructure, whose financial return is still speculative. And when you adjust free cash flow to reflect that reality, the number drops dramatically. In some cases, the company that appeared to generate $20 billion of free cash flow per year is actually operating with cash generation much closer to zero. And how are these companies financing that gap? With debt. Microsoft today carries more than $80 billion in long-term debt. Amazon exceeds $140 billion when you consolidate all its financial obligations. Alphabet, which for years operated virtually debt-free, is issuing bonds in growing volumes. All of this rests on a premise the market is accepting with a kind of faith that, historically, tends to come right before the biggest corrections, that AI will generate enough return to justify everything. But who is actually paying for AI today? The most honest answer is the tech companies themselves paying each other. Microsoft pays NVIDIA for processors. Amazon invests in Anthropic, which uses AWS credits to train models that are then sold back to Amazon's own customers. It is an ecosystem where money circulates largely within the same closed circle. The real monetization, where an outside user pays a price that justifies the marginal cost of delivering AI at scale, is still being figured out, and history has something to say about that kind of gap between promise and return. In 1999, Cisco was the most valuable company in the world. Its technology was real. The internet was real. But investors paid a price that front-loaded decades of growth all at once. Cisco's stock took 22 years to return to its year 2000 peak. In 2000, telecom companies buried fiber optic cable across every continent on the premise that demand would grow exponentially. The premise was right. The timing was wrong. The debt destroyed companies that had the right technology, the right market, the right vision, but the wrong balance sheet. Now look at what is happening today. Nothing presented here is proof of fraud. Stock-based compensation is legitimate. Buybacks are permitted. Depreciation is an established accounting principle. What we are discussing is the difference between what the numbers communicate and what the numbers actually mean, between what you believe you are buying and what you are actually buying. And that difference has a very specific name in financial markets. It is called mispricing risk. Maybe this time the returns from AI will justify everything. Maybe the business models that will monetize this technology at massive scale have not been invented yet. Just as in 1995, nobody could imagine the business model of Google. Whoever sold Amazon in 2001 missed one of the greatest returns in investment history. The question is not whether AI will transform the global economy. It almost certainly will. The question is whether the prices you are paying today reflect the current financial reality or a projection of a future that may not materialize on the timeline the market is assuming. Artificial intelligence is real. The transformation it will bring is real. The money being invested in it is real. But there is a difference between a real technological transformation and a profitable financial investment, between a company that will change the world and a stock that will multiply your wealth. History always looks inevitable after it happens. In 2003, it seemed obvious that the dot-com bubble had to burst. In 2009, it seemed obvious that the American housing market could not keep rising forever. None of those collapses seemed obvious before they happened. Each one was preceded by years of powerful narratives and numbers that appeared to confirm the thesis. Maybe AI is different. Maybe the returns will justify the investments. Maybe the market is right, but maybe not. And that uncertainty is exactly the kind of thing that should be at the center of every investment decision you make, not at the margins, at the center. The question is not whether AI will change the world. The question is, at what price are you willing to believe it? If this video made you think differently about something, hit like right now. Share it with someone who invests and has never asked these questions. Comment below which parts surprised you the most. And the video appearing on your screen right now continues this conversation from an angle you probably have not considered yet. Go watch it.